is gold is doing something it's never done before. It's at a parabolic rally despite stock market volatility at multi-year lows. 90-day volatility in that stock market is just very low. It's like never happened. So what is it? Is it warning us or is it faint? And we shall see.
Gold today. Gold is coming down. I still expect gold to break this first support level, which it bounced at. That was a perfect call. I nailed the top here. Good support here. Got a little bounce. I still think it's going down here and potentially these lower levels. Gold has not broken yet. Let's watch here in the coming days. I do anticipate gold to break lower. All right, let's look at silver real quick. Silver, same thing. I'm anticipating further downside on silver. Next move down should yield a price target. There'll be a little bit of support around 44, but really I'm looking at that 42 to 43 is where I start nibbling a little bit most likely on silver.
Gold's parabolic rise has sent shockwaves through financial markets, not just for its scale, but for the timing of its occurrence. Despite historically low volatility in the stock market, gold has rallied to record highs, defying conventional correlations and signaling that something deeper is shifting beneath the global economy. As equities remain calm and yields drift lower, gold's explosive performance suggests it's responding to underlying systemic pressures, a market sensing fragility, not strength. This divergence between risk assets and real money could be the warning flare that few are heeding. McGlone, senior macro strategist at Bloomberg Intelligence, and Gareth Soloway, veteran technical analyst, both highlight that gold's historic run is less about greed and more about caution. They point to stretched valuations in equities, weakening industrial metals, and the fading of crypto's leadership as signs that the market's balance is changing. In their view, gold's strength amid tranquility is not a fluke, it's a forecast. As investors chase momentum in stocks, the smart money is quietly repositioning toward safety. The signals are clear, and the patterns are repeating. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
My research was gold was going to outperform everything on a risk-adjusted basis. It has. Silver basically trades double the volatility of gold, and it's on year-to-date, it's up 60%, and gold's up 50%. So risk-adjusted, silver should be up 100%. But of course, it got to that new high, and that's all it did. But my bias remained back of gold. Everything I saw was that all markets were getting stretched. We had almost a perfect storm for gold. I think gold just absolutely loves our new president and pushing back on the Fed and tariffs and kind of disrupting the world order. In addition, we have major geopolitical things keeping the gold market quite bid. The continuing war in Ukraine, and obviously other wars going on. But to me, it's also the bottom line I saw for gold is the U.S. stock market just getting historically incredibly expensive, and it's actually historically incredibly more expensive now. And gold's been kind of the offset on that. So I think the thing is for gold, it reached a pretty significant threshold around $4,000 an ounce. That was as far as looking at relative to virtually every moving average. I had to use 40, 50, or 60 month, 200-day, whatever one you want to use. It's basically the most stretched it has been since the late 1980s. And so I think it's reached a pretty good plateau. So for next year, I'm quite concerned with gold signaling. Certainly in a year with gold going up and crude oil going down, and that disparity being the greatest in history. Okay, we don't go back 100 years, but crude oil didn't really matter 100 years ago, is quite scary from my standpoint, from what I see what it might mean. That's a problem, and inflation above targets. But then also what's really changed is Mr. Trump pushing back on the Fed. Every time he speaks, gold loves him. I think that's what changed. But markets front-run events and fundamentals, yes, are all bullish for gold, but the market's already priced in a lot of that by getting, the best year since 1979. You go back 100 years and still up 51% on the year as we speak on October 28th. This is the fourth best year of the last 100 years for gold, and the only three preceding one are 1979, 1972, and 1973. Massive inflationary periods. What's happening this year is gold is doing something it's never done before. It's at a parabolic rally despite stock market volatility at multi-year lows. 90-day volatility in that stock market is just very low. It's like never happened. So what is it? Is it warning us or is it faint? And we shall see. But that's part of the reason I think when you get this kind of excessive appreciation in the store value in a short period of time, it's usually a sign of it should stall at these levels for a while. So 4,000, or even from here, a normal 30% correction is normal. I mean, that's what happened on the way up in 2006 and 2008. That's part of a decent bull market, but each time it corrected 30% from less overbought levels than we are now, according to most moving averages. So that's the key thing to remember is in markets, the answers change constantly. It's trying to keep up with those. And that to me is why we are very concerned. I'm actually somewhat scared by what gold's been doing this year. Now, it's been nice to be on top of that trade, and I get a lot wrong. And crude oil going down, it's nice to be on top of that trade. But the main thing I've been getting wrong, trade, and the main thing is this excessive appreciation of wealth in U.S. and the lack of a decline in U.S. Treasury bond yields, which is potentially just getting started. When you go back 50 years, I'm just going back just about 20 years to 2006 and 7 and 8. Gold's had, there's periods from lesser overbought levels just we had recently. It's stagnated for years. It's corrected 30%. Is it different this time? Maybe. We'll see what's going to drive it further. So I just look at it. It doesn't, again, yes, right now, the fundamentals are known knowns. I mean, they're in the New York Times, so you can read the cover. and it's just how known it is. And that's typically where you have to be very careful loading up in bull markets. Like I said, I took the pain for many years when I thought it was going to break out. It finally did. And now's not the time to overweight longs in gold. And hovering around 4,000 for a few months would be a great sign of just a bull market time correction. Dropping 30%, I think, would be pretty significant buyers, maybe down to 3,500. That's just normal historically from such stretch levels. But now this is where I have to say, sometimes you have to just, when you've made a decent amount of money, if you're a strategist, you give some back to the market, sit back and wait. It's one of the hardest things for traders, investors to do is not trade or not invest and just wait for opportunities, particularly when you've been giving a gift like this. This gold rally, for those of us who've been bullish gold forever, is a complete gift. I mean, it's the best year in 100. I don't expect to live 100 years. It'd be wonderful, I do. But I don't think I'll be trading that long. So that's just how extreme. That's a key thing to mention, traders. When I can make statements like this, that we've had the most extreme disparity between rising gold and falling crude oil ever, in a year the stock market's just doesn't really care about till it's lowest, that's kind of strange. I mean, is this going to mean something? To me, I'm looking more at the macro. Is this going to mean something as we look back from the future? Is it telling us something? Is this warning? And I think it is. And that's where I look at the next key signal. So this is also happening with bond yields ticking lower. So when people are talking about inflation and debasement, like that doesn't usually happen with bond yields ticking lower. And then if you want to look at deflation, look at China. 10-year note yield right now, as we speak in the U.S., is 3.98, and China is 1.81. That's deflationary forces in the world's second largest economy. So the macro is pretty significant. Who's the largest buyer of gold on the planet? China's central bank. Largest demand pull user of copper? China. And who's the target of a lot of these tariffs in the U.S.? China. For that to happen, I love watching that gold-silver ratio. It was great. And it was great. It was been giving me some good signals this year when it popped above 105, when volatility in the stock market spiked in April with the tariffs. That was a good signal. It was a bit expensive. The highest closing price in the gold-silver ratio in the history of mankind, I think, has been 90 or right around there. So we're already above that. Right now we're at 84. And then it dropped down just below 80 recently. I put out a buy signal, not so much a buy signal. Say this is good support, you're supposed to buy. And here's a key thing that's different. Volatility is extremely low in the stock market. It still is extremely low, yet it's popped up from that 78 low 80 and it's heading back higher. So that gold-silver ratio is a great indicator. It goes back hundreds of years, but the world's completely changed. And what's changed is silver is less and less of a precious metal every day. It's just much more industrial. Solar panels, obviously. And gold is being hoarded by central banks more so than any other metal. People don't really hoard silver anymore in central banks. So that ratio is awesome. I think it was a great indicator. And recently I just put out, if you're going to buy the dip, I meant not the stock market, look at gold, silver, partly because it dropped below 80 and volatility in the stock market's really low. Now, gold, silver has bounced, volatility in the stock market's still very low, and the stock market's at record highs. So far I've been wrong about the stock market part, but also I do love looking this S&P 500 in terms of ounces of gold. It is the key level is about a 1.57. Right now it's 1.74. That's dipped below that a few times here and keeps bouncing up. But the first time it tested that ratio was in 1929. That's when it closed. Now that's monthly data. And every time it breaks down below it, it's been hovering on that level for a few years now, actually since 2014. So I think it's about time it's going to break down below it. But the key thing now, it's much more the stock market driving, because gold's had its move. It's way parabolic. It's way expensive. Historically, you're not supposed to buy this stretch versus most moving average. You can use 60 month as an example. So now it's about if the stock market can keep going up. And to me, that's the next key thing. Just now, here's what I love watching is some of the ratios are so significant. The things I'm seeing happening now is I'm so worried with the S&P 500 total return right now is 18% a year. If it's just were to give back 5 to 8% of that, I just see crude oil ready to drop hard. I see copper at major risk of dropping, which is around 5 now, backing down, going towards 4. And then I look at bond yields, they're ticking down despite the stock market going up. Yeah, okay, the Fed's going to ease, but in this complete consensus that you got to buy the dip, stock market goes up, can't fight the Fed. Yeah, good luck with that, because everybody says the same thing. You got to watch the lessons of Benjamin Disraeli. What we generally anticipate does not occur, so be very careful. So that's why I'm watching that very closely and very concerned. And the key thing I'm watching for all leading indicators are cryptos. Bloomberg Galaxy Crypto Index is up 8% in the year, with the S&P 500 up 18%. That's horrible performance for something that trades 3 to 4 times the volatility. Bitcoin's up basically a little bit more than S&P 500, yet it trades 2 to 3 times the volatility. Very bad performance. So the indications for risk assets to potentially give up more of their performance versus gold will come from the risk assets now, not gold. To me, that's what I'm watching closely. And the Fed's going to ease this week. Obviously, this is not going to be played until next week, and the stock market has to go up. And that's what I'm looking at as alternatives now, potentially are more in treasuries rather than before. It was cryptos. They were great leaders. They got too expensive with Bitcoin 100,000. Then gold was a great outperformer this year, one of the best ever, and that got too expensive. So what's left? That's why I'm looking at the risks of normal deflation from the inflation, which is the lessons in history, which is happening in China right now.
Gold and silver are both showing signs of technical exhaustion after an extraordinary run, with prices now hovering near critical support zones. The metal's failure to sustain momentum above the $4,000 level suggests that a short-term correction may already be underway. Gold's structure remains vulnerable to further downside, and silver's price action appears to confirm the same narrative. Both are approaching key retracement levels that could trigger renewed accumulation once selling pressure eases. Meanwhile, equity markets are sending mixed signals. The S&P 500 has breached a long-term support trend line on the weekly chart, hinting at a potential correction phase after a prolonged advance. Combined with stress emerging in the banking sector, as evidenced by a sharp rise in emergency Fed lending, the warning signs are mounting. Liquidity strains and record valuations rarely coexist without consequence, and the charts are beginning to reflect that reality. Let's get back to the interview.
Gold today. Gold is coming down. I still expect gold to break this first support level, which it bounced at. That was a perfect call. I nailed the top here. Good support here. Got a little bounce. I still think it's going down here and potentially these lower levels. Gold has not broken yet. Let's watch here in the coming days. I do anticipate gold to break lower. All right, let's look at silver real quick. Silver, same thing. I'm anticipating further downside on silver. Again, you're stuck within this bigger parallel here, marking the 08 low and the COVID 2020 low, with the bull market high for silver in 2011. That's what gave me this high pivot here. And ultimately, again, today we are coming down. Next move down should yield a price target. There'll be a little bit of support around 44, but really I'm looking at that 42 to 43 is where I start nibbling a little bit most likely on silver. Oil again has been forming a little bit of an inverse head and shoulders. We talked about it yesterday. Again, there's your shoulder, there's your head, there's your shoulder. But remember, until it breaks the neckline, it's only a formation. It doesn't trigger. Triggers occur on a daily close, in this case, above the neckline of the inverse head and shoulders. That's where the odds increase substantially. Right now, it's just a fun pattern to watch. And again, that's great because you want to know when it triggers. But I caution people against jumping the gun on inverse head and shoulders and head and shoulders. They can form, but until they actually trigger by breaking the neckline. The dollar today, the dollar is bumping up against resistance here. I have my zone of resistance going back here to 2023. We are in the lower zone. We talked about how I think I had calculated out an inverse head and shoulders target going back from here, right? We talked about this a few weeks ago, right? I haven't really talked about it much since, but believe it or not, it never negated and was still on pace for this target, and we're essentially hitting it now. Speaking of inverse head and shoulders or head and shoulders, Meta, don't forget about Meta, folks. It continues to spiral lower after that head and shoulders finally hit target. Price has not stopped going down. The 10-year yield today is flat to negative. We're still around 4.1%. That is still elevated as the risks of no cuts in December continues to be a plausible scenario. And if you look at the Fed watch tool, they are still pricing in a cut in December, but then no cut after that until basically Powell's out of office. And again, then we all expect like 50 basis points at every meeting probably. But again, a lot will be determined by where inflation is. Okay, inflation, again, while the metrics have been a little bit more muted, if you look at specifics that are affecting you and I, energy, food, still 6% inflation, 7% inflation on the metrics that most of us spend a majority of our money. All right, let's go to the S&P 500 daily, or actually we'll flip it right to the weekly. This is the one I've been showing you guys. And again, it is a thing of beauty. In my opinion, we're on the verge of a correction. We might have even started it. Here's your weekly chart of the S&P, your COVID low, your bear market low, subsequent pivot lows right here and here, and then your liberation sell-off low. And sure enough, you map that to the bull market high. And what did we get on the weekly chart last week? We pierced, we closed below. Yesterday, we opened above and we closed below. This, my friends, could be very damning for the markets in terms of telling us a bigger sell-off is coming. So one of the things we've been talking about is Jamie Dimon and his warning about defaults in the banking sector, about loans going bad, a spike. Where there's one cockroach, he said, there's many, many others. Take a look at this, guys. This is the Federal Reserve Bank of New York's repo operations. Okay, if we scroll down, look at this recently. These are banks borrowing money for emergency purposes in the last couple weeks here. Look at the spike up. Friday, we saw a total of $49 billion between treasuries and mortgage-backed securities. And yesterday, we saw another $21 billion being borrowed. Now, put that in perspective. If we flip to the yearly chart on this, look at the yearly. All right, does this look a little interesting? Like, look at all the usage right here. And if you go back in the entire last year, there was one point here where basically $11 billion was borrowed, and that was it. That was in July of 2025. Aside from that, nothing, literally nothing in the last year was utilized by banks in terms of emergency lending. And just to understand, the repo facility was made permanent in 2021 following the big banking crisis we had back then. And essentially, it allows banks to put up treasuries as essentially, to kind of warrant the lending from the Federal Reserve of this money. All right. So again, the Fed is willing to lend these banks essentially almost unlimited funds that in the banking sector, there is more trouble brewing. And again, just to go back to this chart, look at that, folks. Look at this, what's going on recently. Now, again, does this mean we're on the verge of a financial crisis? No, it doesn't mean we're on the verge of a financial crisis, but it certainly means there's stress in the system. When you compile that with valuations of stocks, right, basically at potential levels of other bubbles, when you combine that with what we've talked about with the charts, when you combine that with a labor market that is weakening, and we talked about yesterday how Chipotle, how McDonald's, how all these kind of lower, basically eateries, fast casual, that was kind of just like, oh, we could run in there for $10 and get whatever. Now it's $20. Like, you're lucky to get out of Chipotle with chips, guac, and a burrito for less than $20. And that's putting pressure on a massive amount of the population.
Gold's recent pullback is not a failure. It's a pause before the next primary phase. The metal has absorbed months of heavy speculation, central bank accumulation, and macro tension, and now it's consolidating at historically strong levels. While traders focus on short-term weakness, the bigger picture still points to structural strength. The long-term setup for gold remains deeply bullish as global liquidity tightens, sovereign debt risks accelerate, and banking system fragility resurfaces beneath the surface. Silver, too, is aligning for its next move, quietly coiling below resistance, waiting for a catalyst. The correlation between declining bond yields, rising repo stress, and falling equity momentum is no coincidence. It's the early signal of a broader market repricing. The smart money understands this. What feels like calm now often precedes a period of acceleration. Share your thoughts on their analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.